embarking on a quarter century of excellence.
Hello and welcome to a brand new episode of Smart Money. This is our year-end special. We are heading into a brand new year, and guess what? 2023 has been phenomenal for everyone in the market. It's been a big bull market that we have on our hands. But the topic that we have today is how do you start your investments if you are Gen Z. Now, Gen Z is the largest category of spenders. If you look at, in India, globally as well, India has the highest population of Gen Z. So they are the target market for most marketeers, for most investment bankers, etc. So we're trying to understand how this category of investors can look at investing in the market and why it's important for them to start early and what's the right approach. We have Feroze Azeez of Anand Rathi who joins in on our year-end special. Feroze, thank you so much for joining us. It's really been great times for the market. So I want to start with that. The one thing that the new generation has on their hands is time. And why do you think it's important for them to start investing early?
Yes, like you rightly said, Gen Z are those 25, 26-year-olds at best, right? I think Gen Z, as the lingo goes, starts at 1997
yes.
or something like that, right? So the oldest Gen Z would be about 25, 26. So time is certainly there. Time is there. There's an advantage of investing for the long periods. But there's also a disadvantage that you're not earning too much. Compounding is your friend, but your employer is not, right? He's not paying you a lot of money, right? So if I was a Gen Z today, I would look at what is the current Indian environment going to look like and what's the shape it's going to take for the next 15, 20 years. And if you look at that, this is one of the most fortunate set of generation because you are at the cusp of India doing very well. Why do I say you're still at the cusp of it doing very well? Because like last time around when there was so much hoo-Allah about how the global economy is doing, that was 2013-14, before COVID, we were called a fragile five country. We were called one of those fragile fives. Today, when you see, we have our relative importance in the globe from an economic and the capital market standpoint right at the top. Why? Because India is not facing the two biggest problems the globe completely is facing. One is inflation and the resultant interest rates. India's inflation is lower than the 10-year average. India's interest rate is 3%, but it is 6.8 is the average interest for the last 10 years. You are at 7.1, 7.2. Now you just go to other countries. US has seen this kind of inflation 50 years back, 40 years back. Interest rates 20 years back. So you are a fortunate generation if you're a Gen Z because you have a relative significantly higher importance as a country and your investment destination. That's point one. Point two, long-term an economy is going to dictate the capital markets. In the short term, news will overpower. In medium term, corporate earnings, how much are these companies earning, will overpower. And in the long term, it's the economy. And six out of the seven variables I look at consistently over the years are a big bright green.
Okay. So, I get a lot of questions from the younger generation as to how they should start their investment journey, and they get this FOMO factor. Markets are at all-time highs. How do we go about it? It's very overwhelming. Forget Gen Z, even millennials, the guys in the 25 to 40 age group, some of them have missed out. What are some of the fundamental steps that you need to look at before deciding to invest in the market?
Firstly, I'm not surprised that the youngsters are calling you. More often because you look young, you look more relatable as a news anchor. That's the reason why they call you. Now coming back to when these young people want to invest, first is stop thinking a lot and begin somewhere. That's very important. Of course, goal setting is important. Creating budget is important. Not getting carried away is important. Personal finance has 3, 4 very, very important elements. But the most important thing is begin somewhere, right? And these are hygiene items which you can put in order. That's my first suggestion. Every time you get a salary, if you're not investing even 500,000 rupees, then you're not even dipping your feet in the water. And you're not going to be able to swim. I know there's a lot of technique needed for a backflip and all those. But the point I'm trying to make is if you don't dip your feet in water, so start early, by which I mean, even if you've not got the full house in order, just start with a flexi cap fund. so that you at least get a sense of how the logistics of an investing works.
Okay, so just start with a flexi cap fund. If you are somebody who's, just got your career started, 1,000 rupees, 2,000 rupees a month is something that you should look at investing. Got it. Whether it's millennials or Gen Z, why is budgeting important? Now, I'm asking you because a lot of us still have not cultivated this habit of budgeting, right? But why is it important?
Why is it important is because you have income, you have expenditure. Income is not something which is variable, right? Budget every month could change. So the equation is income minus expense is your savings. And then savings results in investments. If this is the equation, one is a constant, which is your income is a constant. Your expense is not always constant. So if you have a variable in the equation, which is going to determine your savings, you better have control on that variable. And the process of gaining control on the variable of the equation is budgeting. So if you have budgets, you know there are once you do budgeting, then you know there are discretionary, non-discretionary spending items. A rent, you can't say, this month I don't want to pay rent, right? That's not your choice. So that's not a discretionary item, it is non-discretionary. You going to the mall and watching a movie in the best multiplex is a choice. It's not something which is forced upon you. Okay. So that's why budgeting is very critical.
All right, that's on budgeting. Let's talk about asset allocation because that is one of the, I think, cornerstones of creating a good portfolio for yourself, right? Generating wealth. For someone who is in this Gen Z category or early 20s, late 20s, do you think 80% should be in equities? Should there be more in equities? What about debt? And also, how do you allocate to some of these other assets like gold, sovereign gold bonds, silver, etc., which is now picking up?
When it comes to asset allocation, my first tip to Gen Z is stop listening to your parents with respect to asset allocation.
Okay.
That's very, very critical. Because
why do you say that?
I thankfully didn't listen to my dad on the asset allocation bit. I'm more an obedient child from the rest of the perspective, so I at least have the leeway of not listening on one or two items. And if there's only one thing I don't have to listen, and everything else, I would choose asset allocation on my basis rather than his experience basis. Why? Because the previous generation came in an environment which was survival of the fittest. India has not been an easy country to live in, right? That's why so many of Indians migrated, became NRIs. Today, people still debate whether you want to or not. If there's going to be a very, very tough environment to live in, people will obviously go with the conventional mindset, roti, kapda, makan. And that automatically brings an asset allocation of makan, second makan, third makan, right? So point is, there is going to be love for physical assets in your parents because they've come up with a lot of partition and sometimes wars and all that. So the love is coming because of insecurities, not because of mathematics. If I analyzed almost about 932 properties in the last 6 months, the IRR is 8% of residential Indian metro city. 8.3%. It's of course beaten an FD, but equity in the same period has given him 15% return. So math doesn't add up. Insecurity is the reason why India loves physical assets. Now let's go to gold. India has been the largest importer of gold, give or take, from 1990s. Are we the richest country in the world? No. We consumed so much gold. If gold, which is a global asset, was so good and it performed so well, we should have become the richest household in the world, which we have not. That's because math is not favoring. It's the insecurities which is bringing love for physical assets. So a person, if he wants to do great, prudent, mathematics-based investing, not heart, but the mind, then at least 70-80% will have to go into equity.
It's interesting you say that, a lot of us face money trauma because of what we've gone through in our childhood, right? So there's this scarcity mindset versus abundance mindset, as they call it. A lot of us are first-generation wealth creators because our parents never really put their money in cash-yielding or high-yielding assets. So because of that, a lot of us, despite having the money, don't have the propensity to spend it. But that's a debate for another day. We'll talk about that. Let's get back to Gen Z investing, right? Let's take an example of a 21-year-old who is just perhaps entering the workforce, starting with, say, 1,000 rupees per month through the SIP route. How much can that 21-year-old generate by the time he or she is 45?
Okay, that's another 24 years.
Yes.
If you look at it, the numbers which I know back of my palm are the ones which are for 30 years. So I'll probably take it off.
Sure.
So every 1,000 rupees of SIP for 30 years has the potential of becoming 54 to 55 lakhs. in 30 years. 1,000 rupee consistently invested for 30 years, which is not very easy. The person would be 51, but every 1,000 rupees can give you 54 at a 14%, 13 to 14% return, which is a very fair expectation from equity, at least in an economy like ours. Now, if one were to say that 21, let me go through a honeymoon period of professional life and start investing by 26, then the same 54 lakhs at the same rate after a 5-year delay becomes only 27 lakhs. So the first 5 years of delay, the honeymoon period of earning, because you've always been brought up with a pocket money, there's scarcity of money, and suddenly you start earning, you're not going to be saving from the first month. That's unreasonable to expect. But having a 5-year honeymoon period and investing after 26 is also wrong. Maybe take a 6-month chill pill, spend all the money you get. So a 5-year delay brings down your maturity amount by half, which I think is going to be a very expensive mistake to do for a Gen Z.
Yeah, we have a very helpful table. If I can just ask my director to, prop up that table here for us. It's very interesting. You speak about how 1,000 rupees per month will get you, okay, here you have it. So this is basically a total invested amount of 15 lakhs. That's a 1,000 rupee SIP for 25 years. On an annual return on an average basis, 18%. So the total gain that you're making in 25 years is 3 crores, right? The total amount, the corpus that you have built. Is this including a top-up SIP or is it just 1,000 rupees? If you do a top-up, then what will the numbers look like?
The numbers would be astronomically high because here time is in the favor. This is 25-year data. These are all funds with 25 years. Like I said, every 1,000 gets you 54. So that's almost about 2.7 crores, right? But the past is past. This is 3.15. In investing, there's nothing called present continuous. Past is past and the future is expected return. So that's why I said 55 lakhs per 1,000. But this has been almost little over 60 lakhs per 1,000. But this is not a top up. And if you top up, then comes the question, by how much? If you top up by 10%, you will see amounts going upwards of 4 crores.
Okay.
Just by a 10% top up every single year. That means there will be 25 top ups. If you did 10%, that means the first year is 5,000. The subsequent year is 5,500. The subsequent year is 6,050, which is 10% increase. If you did a 10% increase, I won't be surprised if it went to 4.5 crores.
Okay, so you're saying that as someone who is Gen Z, if you start by just investing 1,000 rupees per month and top it up by 10% every year with your bonus, increment, whatever, in 25 years, you can be having a corpus of 4 crores in your account.
No, that's for a 5,000 rupee SIP.
Oh, that's for 5,000 rupee SIP. Okay. So a 5,000 rupee per month, which is also not much if you think about it. I mean, you go out for one movie and there you have it, you've spent 5,000 rupees.
If you just buy a popcorn, that will be 1,000 bucks currently with the kind of inflation.
Absolutely. So 5,000 is not much, guys, to take out for your own investment journey and to build a corpus for your future. All right, let's do one thing. Let's step into a short commercial break, but don't go anywhere. We'll come back. Lots more analysis lined up on how Gen Z and millennials can start their investment journey. We'll be back.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back to Smart Money on CNBC-TV18. We're getting set for a brand new calendar year and we're telling you how you should be investing your money. We have Feroze Azeez, the Deputy CEO at Anand Rathi Wealth, who's here with us. Feroze, I wanted to check with you on when someone from, a Gen Z investor is looking to put their money between large, small and mid caps. From where do you think the maximum alpha can be generated?
Yes, so Sonia, this question is very, very important, a question. And if you analyze data, without any biases, look at the one thing when you're buying an active fund, you're worried whether your fund will outperform. That's the first question you'll have. That's in the future, you will get an answer to it, not before you invest. And after it is there, how much did I outperform? So one is the odds of outperforming itself. In a small cap are 47%. In a mid cap is 46. In a large cap category is 37. So the odds of winning are low in a large cap. The next comes, how much do you win when you actually win? In a small cap, that's where the stark difference is 12.88%. So the small cap scheme, which actually has a 47% odds of beating Nifty, when it so does, it beats by 12.8%.
Okay.
In a large cap fund, the probability of beating Nifty is about 37%. When it so does, it only beats by 3%. So that's why a person who has time at hand, which is a Gen Z for sure, should definitely have larger proportions in small cap.
Okay, I have a follow-up here. At this point in time, do you think that's a good strategy? Because now the narrative is that large caps will start to outperform in 2024. So for someone who's investing now, should their view change?
I would say no, because you're again speaking of long term when it comes to Gen Z. That's point one. Point two is that when you're going to be systematically investing, it's very unlikely that the Gen Z is sitting on 5 lakhs to invest. He or she is going to be doing 1,000 a month. The more the volatility, the better will be the averaging for him. So you don't have to be worried about a fall, because the next installment is going to be bought cheaper. If it goes up, you still have a good news that the installments which have already gone in. So I'm not too worried about small cap valuation. If you look at small cap valuation also, there is a stock in small cap index with 9 PE. There is also a stock with 200 PE. So painting them all in the same brush is making it too simplistic. So I think I'm not too worried.
So the basic point is, if you are a person in the category of 20 to 30, it makes more sense for you to invest in small caps rather than large caps over the longer term, right? So put larger allocation to that. Got it. What are the funds to invest into? This is the most common question. I'm sure you also get asked this a lot. What are the top, say, 5 or 6 funds that you would recommend investing into in 2024?
Yeah, there are several funds you can invest in, but when it comes to buying a mutual fund basket, your expectations should be clear. You will always, when you buy 6 schemes, 1 or 2 will be turning duds over the next 1 year. If your expectation is all 6 are going to be a strike rate, you're not buying a Sachin Tendulkar, okay? So you have to remember that. That's having said which, if you look at large cap category, I would definitely buy it. Franklin Blue Chip, that's one, which is managed by now Janki Raman, who's the CIO. It's a smaller scheme, 7,000 crore scheme. So my belief is that it has the potential and the agility required to beat Nifty in the future. The past performance doesn't show up that good, but I'm still saying that. Now you have this DSP Equity Opportunities Fund, which is a large and mid-cap scheme. When you look at DSP, I think their strength from Vineet Samre's standpoint, which is mid-cap, bottom-up smelling businesses much before, I think that's what comes to your rescue here. Kotak Emerging Equities is, of course, was managed by Pankaj Tibrewal, who's now on the way out, and Harsh Upadhyay is a person who's going to be taking it over.
I was going to ask you about that, because Pankaj had this penchant for picking up stocks which were multi-baggers, right? I mean, he had some of the best multi-baggers in his list. Now that he's on his way out, do you think the fund could suffer in any way?
See, I don't believe that it can, because Nilesh Shah, who's the CEO of the business, if he's a technical CIO in the past, their capability is very different. If you make a general manager as the CEO of an asset management company, the fund's performance suffers. Now, if you see HDFC, Navneet Monot has been a CIO. Bala has been a CIO. And you see Nilesh Shah himself has a very, very good sense of equity. So I personally think Harsh Upadhyay with Nilesh managing a 20 large scheme. It's not a small scheme that Pankaj's stock picking could have helped so much. If it was a 200 crore scheme and Pankaj was buying multi-baggers, then the performance was attributed to that small scheme. Because it's a large scheme, I think it'll have the attention from Nilesh.
There's one, I don't know whether I'll call it a misconception, but there's one conception that the larger the scheme, the tougher it is to outperform the benchmark. Would you agree with that?
I will completely agree. In closed doors, most fund managers tell me this. And mathematically, very few have been able to defy this logic, one being Chirag Setalvad. For Chirag Setalvad has been, irrespective of the size, has been able to generate immense alpha in a small cap scheme. So much so that I had to put 2 people to do a research of why this happened. So I concur with your conception.
But you're still recommending these large schemes for Gen Z?
See, it becomes difficult. It doesn't become impossible. So relatively, given a choice, if I were a fund manager, give me a 2,000 crore scheme or a 20,000 crore scheme, the odds of me beating the benchmark is higher in a 2,000 crore.
Okay, if we can just get the schemes up back on the screen over here. So we were going through some of them, right, that you like. There's DSP, there's Kotak Emerging Equity Fund. Tell us a little bit about Invesco. This fund has done very well. Just look at the performance, 5 years, 40%. Do you think it can replicate that?
I think it can, but not 40%. That's a little, because the point also has a trough of small cap as the beginning point. But if you look at Tahir Badshah, who's the CIO, and he's managing the scheme, it's just about a 1,400 crore scheme. That's when you are having a mix of a large scheme, you have a small scheme as well, and in a small cap scheme, you want some 1,400 crores, 1,500 crore, with the CIO paying attention. And Tahir Basha, when he was in Motilal Oswal also, has got a great track record to smell businesses and do some justice to the money. So I think agility is very high, and Tahir Basha is a CIO, and he has created credibility enough to manage a small scheme.
Okay, very quickly, any other schemes that you would recommend apart from the ones that you suggested here?
If you look at from a SBI Contra standpoint, that's one scheme managed by Dinesh, which has a complementary nature. Okay. Because SBI is missed there, so I'll say SBI large and mid cap or SBI Contra can be included in this scheme, because SBI is the largest asset management company. I love the way Vasan displays courage, who's the CIO, R. Srinivasan, displays courage. I think that's a very important attribute of fund manager, not just the analytics, but the courage to act on his conviction exists.
And you also like quant funds. I think Sandeep has been one of the biggest success stories in the mutual fund space in the last couple of years, but still good to go for more?
Absolutely. See, what is so different about Sandeep Tandon is he comes from a treasury mindset, not a fund manager mindset. As far as I have understood his mathematical models, last year we approved his scheme in our portfolio, so we had to go through a lot of research. Momentum, risk and price. All these are very, very good decision-making criteria mathematically which support him, which I think has proved very well, and I'm very, very confident that he's been able to generate alpha. Of course, that's fact. But I think I would definitely extrapolate that alpha in the future as well.
Okay, Feroze, very, very informative episode. Thank you so much for joining us, and Happy New Year to you and your entire team at Anand Rathi. Hope you continue to do well for yourself. This has been a great year for your business, and hope that continues.
Thank you for your wishes, and wish you the same.
All right, with that, it's curtains down on Smart Money. Thanks a lot for watching. Have a great weekend.
CNBC-TV18, embarking on a quarter century of excellence.